Hello ladies and gentlemen, welcome to today's webinar. I'm Joseph Novichkov, Senior Trading Manager with GDM. Today's session, ladies and gentlemen, we will have a look at our second webinar for this month, and we will be talking about the grid entry points with Fibonacci time zones. Not only, I will also give you a few other good ideas on exit strategies and of course on following the trend techniques, which could help you as well as to keep your positions on the optimum profit levels. So before we step into the Fibonacci time zones, I have to let you know one more time, for those that have been missing from the past webinar, they should know that all of the webinars this month are connected. So as far as you need, you can review the past webinar in our YouTube channel as it's been recorded, as well as this one today. For further future reference, of course, is to get to the basic concept on the vertical grid. Since today's session, we will actually continue from where we stopped the last time, as the previous webinar was themed the trading the trend with vertical grid, which was a concept technique which allows you to enter the market on equal time intervals. However, today's session will bring you a little bit closer to our final goal, which is the dual grid trading technique. Of course, is also into our advanced range trading systems. Furthermore to that, of course, later this month. Right now, I need to remind you on what exactly we're focusing on. Now, the previous webinar, ladies and gentlemen, we grasped the concept of the vertical grid by understanding what a vertical grid is, first thing. The second thing is the type of flexibility that the vertical grid trading the trend technique gives you, and this will be also reminded in today's session later on into it. One more thing to remind you is what exactly the focus of this grid trading technique is. It's that it is also called dollar cost average, and this is pretty much one of the oldest techniques on the investment business, as well as it rather focuses on the time intervals and their entries rather than the price entries, which is actually the axis grid. So the vertical grid and the Fibonacci time zones are pretty much one and the same thing. But the slightest difference is that you can actually customize your Fibonacci time zones by the number of the entries that you might want to take a look at. This is pretty much from 0 to 24, 32, whatever that you actually choose a level of those time zones. However, the time intervals in the vertical grid, as we mentioned, do not necessarily have to be consistent in time. So some traders use the time axis indicators to determine the entry time pivots or their points. One such indicator, of course, is the Fibonacci time zones. The Fibonacci time zones, ladies and gentlemen, is a standard chart object in the MetaTrader 4. And of course, most of the others, the other charting packages, like web-based platforms, like our new web-based MetaTrader 4, you can also find it there. It's pretty much everything that you can find on the MT4. You can find it on the web-based, but the difference is that you don't have to download the MetaTrader 4 to trade on our servers. Proponents of the idea that we're actually looking at today is that significant market events don't happen at a regular time intervals. Rather, they happen at intervals defined by the Fibonacci sequence. As we already know, when we're talking about charting techniques, everything is in a mathematical algorithm, everything follows a certain formula, let's say. So the way this system works is to mark out retracement points along the time axis using Fibonacci numbers. These intervals mark the likely pivot zones where the price intervals could actually happen. Therefore, using this method, the trade timings for the grid are set to coincide with likely pivots in the market itself. With the Fibonacci time zones, the reference points, for example, let's have a few examples here. Okay, we have the time and price axis, for example, here. We have the type of price movement, which is, let's say, in this case, in an uptrend. And we have to find our reference points between point A and, of course, point B. The further down the road, whatever points you might grasp, they're pretty much not in an even time interval. So between point A and point B, that's not much of an A, it looks better now, are usually chosen to be the two significant points on the chart. For example, between two highs or two lows, which are price levels, as our entries are actually going to refer between those 2 points as our first entry and the one that we actually start for. So it's from 0 to 1, 2, 3, 3, 5, 6, 10, for example. We will see further down the road. The Fibonacci zones can then be extended out into the future to give your grid entry time zones. Now, how we can do that, we will see first by finding our reference points. So let's clear everything out and find our particular entries. Now let's consider that the trend has started from here, and as you can see, it's still going. Our reference points from where we're actually going to start measuring is actually the first high and the first low in our already known established trend. Of course, we know that it's a trend when we are making new highs and new high lows, for example, new highs with new high lows, new highs with new high lows, so on and so forth. Now, this is how we know that we are in a trending market. So first of all, now here we have our points, which are A and B, our two reference points on our charts, and of course we can always assume the time zone by measuring it, but let's say our point A is up here and our point B is down here, and let's say it's a distance between, let's say, 1 hour. Even though we're looking at an hour chart, it's much larger than that, but 1, and furthermore, the rounding numbers that we're going to use are obviously numbers that are much better to refer with. Also, considering the fact that our two reference points, as we mentioned, are 1 hour in between, the time interval between the grid trades is then the sum of the previous two. So we start from, as we mentioned, our point A is the first point from where the trend has been established. Of course, the trend starts here, but that we don't know until we get to point B and point C, which is actually our triangulated point from where on we know that it's a trend. However, we're only focusing on point A and point B as our first two reference points. One more time, between them the distance in the time interval is 1 because it's easier to calculate, and I picked the 1 hour chart because it's a better established trend, which eventually in your calculations this time interval here, for example, would be much larger. So between these 2 points is actually 14. So you're starting with 0 plus 14 gives you 14 for the next interval. Then we have 14 plus 14, that makes 28. But let's start with the most simple things, because I see questions here that are relevant to the topic, but it's obvious that you're not paying attention, so that's why I'm moving a little bit backwards to explain one more time, which is totally fine. So, as we mentioned, we start with 1 hour, which means 1 hour plus 0 makes 1 hour, which is our next interval. So we have 1 hour in between the distance, then we measure another 1 hour, which comes somewhere around here, let's say. This one is also 1 hour. Zone 3, for example, because we have 1, 2, 3, is here, and the next distance comes in 2 hours because we have 2 hours, 1 here and 1 here. When you added one in together, it gets you about 2 hours. And as you can see, it expands in time, and so on and so forth. Then we have 1 plus 2, that makes it 3, so the other reference point comes somewhere over here, and you can see the exponentially it's rising the time interval between our entries. But one thing is for sure, we don't really have to do that. We don't have to measure, start writing on our charts, and eventually get something wrong, so the timing and the entry where we've set our preset pivot reference points from our entries could maximally differ between 5 to 6 hours on an hourly chart. So an even larger time frame, it can differ with weeks, months, so on and so forth. And we don't want that, because the slightest mistake that we make with our calculations in our entry reference points, the bigger the disaster could be on our accounts. But what you see in front of you is how actually the Fibonacci time zones work. But what a better example would we have if we actually instead use our Fibonacci time zones and place it on the chart to see exactly what we mean. The place to find it is in insert up here on the left top corner, the third function on the MT4 chart. Scrolling down to Fibonacci, you can see all the Fibonacci tools, and the second one is Fibonacci time zones. Therefore, our measurement now and the placing of our Fibonacci time zones is as it follows. We don't really take the first point from where the trend has started establishing, and this is the doji here, as we can see. We're actually taking the highest high, which is here, and we don't have to necessarily measure the price distance, meaning the price hikes, the actual points here. We're only interested in the time interval, which is between this candle and this candle here. So whatever level I take, you see, with no difference how far I extend it to the upside, it doesn't really matter. It's only going to give you one and the same time zone because it's not measuring price. So I might even extend a little bit higher here so we can see these numbers. And this is pretty much our entries. What I just mentioned is 0 to 1, 2, 3, 5, so on and so forth. As you can see, if we squeeze the chart a little bit this way, you can see the next one is 8. You can see that if we zoom out a bit, it goes 13, 21, 34, so on and so forth. And those are the preset levels in the Fibonacci. But what I can say is that you can just correct this by going into Fibonacci time zones properties, and you can pretty much do everything here, from changing the color as normal, as you already know that, from Fibonacci levels, which you can scroll here, just delete one, for example, or 2, 3, 4 if you wish, so you can be only with these 5, or if you need only 3 entries, you will be able to delete this one as well. And when you click OK, you will see that everything comes down to all these 5 numbers. And of course, we can always rename this one, so it can be pretty much as you want it, 5 or 16. That's up to you. But let me reestablish the original Fibonacci time zones. So as one more time, we're extending it a little bit higher here so we can get this. Correct the levels as normal, which of course gives us a little bit of disaster here, what we've caused, because as we can see, every other one comes in a number of 5, but that's totally fine. We can just correct this by removing them and just get on with it. Now, the most important idea here, ladies and gentlemen, is to understand the Fibonacci technique and what we actually need for our entries. In addition, it is important to note that with the Fibonacci tools are a very big variable, so we have a lot of tools that we can actually use. So in most cases, the grid entry point prices will not converge into the average because the interval size is not consistent. We then are going to use the Fibonacci fan technique. It is very important always for our trend. So the Fibonacci fan, as we already covered a few basics of the Fibonacci fan, of course it extends support and resistance lines into the future, and it works by locating peaks and, of course, very important, throats in the pairs. And of course, ascending fan represents a bullish trend, obviously. The fan, of course, marks lines of support and resistance, already knowing that. The corresponding trend will likely to meet in the future. Traders, of course, will definitely use the Fibo fan combined with other support and resistance lines to decide if the trend is intact or if it has changed. So we can actually take the example of Elliott waves for larger time frames. This is also another technique, but of course this is something that you can focus on your own because it's not pretty much our focus for today. So let's have a look at the Fibonacci fan to see exactly what it offers. This is one of the techniques that we can actually support our positions, or as we mentioned the last time, we can start reducing or accumulating from our positions. This is how, of course, our integrity of the whole system would actually stay intact, or we should just start cutting off our positions. One more time, we go up on the left corner, the third, insert Fibonacci fan. Now we actually have to extend from the first low to the second high for us to better estimate where pretty much our trend is aiming for. And as you can see, it pretty much goes without saying. The particular trend line we've established here is totally useless in this case. We have the Fibonacci fan, we have our Fibonacci time zones, and now we know that our reference point, the mid-level of 50, is actually our crucial level. If the price starts closing below this level, we have to start monitoring this trend, whether it's going to reverse below the 61.8 level, which is here, and if it closes, eventually our system is getting to its end. Basically, you have to close your positions either on a profit or on a loss, because from then on we can expect a change in trend direction. But as we can see, in this particular case, this is something as we have recommended this morning in our trading recommendations that I'm usually dispatching to my traders. We've been recommending is per our overview of the market that the euro is going to go long, based on several fundamental and technical issues here, and the particular trend is intact for quite some time. Therefore, we have the possibility to reach a price target of up here, which is this particular evening star, which is by far beautiful as it gets, as perfect as it can be. So this particular grid technique, ladies and gentlemen, would of course determine where the price is within each time zone, and we know then that we either going to start accumulating or reducing the positions that we have accordingly. Typically, as I mentioned one more time, let me remind it, we use the 50% retracement line as the average, where the trader could start accumulating further positions, or as it also means you can keep adding to your positions when the price reaches that level. And of course, when the price is typically below that level, we can start reducing, and when it finishes below the 61.8, we can terminate the whole system because the trend is expected to reverse. And what happens when the trend reverses? Now let's take a look at the following example. Let's say the particular system continues on an average base like this, for example, and at some time the trend starts reversing down. Now every time the trend goes below here, we reduce our positions, which means whatever profit we have, we can start closing our positions, whether it's going to be the most recent one, which is by far closer to the initial price open, and by far closer to the current price, which would be the most reasonable idea, and keep working down backwards towards the initial price entry, which is obviously somewhere over here in this point. Because here, then on, we confirm that the trend has been confirmed, established, the recent high has been broken off, and we can start accumulating positions. So when the trend reverses down here, we have to reduce all of our previous positions down to zero, collect whatever profits we have, and wait, of course, for another turn of events. I believe that the screen just switched on and off, so I'm going to have to go ahead one more time and just chart this reversal one more time, because it usually happens in a manner of something like this. A curious type of head and shoulders, another retracement to the neckline, and then a further move down, accumulating pretty much the same type of profit between the neckline and the head top, and then reversing one more time to retest the 61.8 level of the Fibonacci, which is pretty much, let's say, by the book type of trading, and usually the market develops this way. You can confirm by just scroll back in a few trending opportunities so you can see how exactly the market reverses. It's either going to be a formation like head and shoulders, or a double top, or a triple top, or something in this form. So the availability that we have in this stage as an establishment of a vertical grid such as this one, it works always well with trending markets. That means directional trend to the upside or directional trend to the downside, meaning bearish or bullish trend. There are, of course, also another thing. So as a summary here to today's session, this is the also called dollar average type of system, as the aim to achieve an average entry price over a certain time interval is the whole essence of the theory. Therefore, the trader has a higher chance of being able to profit from a rising or a falling trend, which is in the short term And of course, because of the possible high volatility, you might not be able to catch certain trades or be able to enter on the right side of the market. Therefore, timing those entries from the beginning of the trend will allow you, obviously, to get to your initial entries. As you can see, we have the another possibility here, entry here, entry here, entry here, entry here also on this particular retracement. But every time the market extends in time period, your entries would tend to be less accurate. However, the average dollar cost, as we are actually aiming for, gives you the initial drawdown profit. So when used appropriately, as I've showed you, a vertical grid can reduce that risk that you're using on the market compared to the original type of block trading, which is one trade on a rising trend and you have committed from the beginning. As we mentioned in our earlier trades on our previous session, that a trader is not fully committed to this particular trend, not until you place your final trade over here in time. So used appropriately, the grid trading is not, I underline, not profit multiplier system. So it cannot multiply your profits. Rather than that, this is a way to reduce your timing risk in volatile markets. Why I'm doing these type of tradings in these market conditions? A perfect trend, you can enter from the very beginning here, profit from the distance between this and this point, for example, in this stage. Well, I can tell you one thing. This is only one currency pair, but you have more volatile pairs like exotics, GBP versus the US dollar, for example. You have gold, you have oil, you have so much market uncertainty at this stage. So having something that will reduce your risk and not being committed from the very beginning is the best way to always stay alive on the market, not only, but actually profiting from these market volatilities that we face every day. Especially, let's have a bit of a reminder here. We know what is happening with gold prices. It's in a huge, enormous range of $36. So basically, when you're looking at a 4-hour chart, it's a very tiny distance, right? But when you switch to smaller time frames, the volatility that is so big can cause terrible losses on each and individual account. And reducing that risk with grid trading will have you on the market for a longer period of time until the conditions from a political or economic standpoint cool down, so we can get back to our standard technical trading with initial block entries, as we usually do, to commit from the beginning, but then you have a steady 45 degrees trend. Right now, the volatility of each and every individual instrument is so big that you can never be able to suggest when the trend is actually going to reverse, because once it reverses with such a magnitude that it actually wipes out all of your initial running profits and even might get you in a loss. So not only the whole period of time from here to here is spent for nothing, but it can actually be causing you a bit of a headache, because you might even lose a few positions. But reducing that risk one more time will bring you closer to your profit potential. Not only exhausting the trend by maximum possibilities and potential, but also reducing the risk meanwhile. So, whatever questions you might have, ladies and gentlemen, just drop them in an email, or if you wish, we can always talk over the phone in the one-on-one sessions. For those that are already trading with us and are here in this webinar, they already know how to do that. They have direct telephone line to our offices. With the extension, you can even get directly to my desk without a problem. But if you are new to the company and therefore you haven't even visited our support department, we have an automatic pop-up chat that you can file down questions that you might have, and of course get directly to me or any of my colleagues to request, of course, a callback or anything else that you need. Furthermore to that, to those that are attending the webinars, as I mentioned the last time, we're running a type of a promotion here in the firm. So basically, because of the higher interest for this particular series and the market conditions that are a bit uncertain at this stage, we're not only giving you the opportunity to give you those hints by free webinars, not only, but on a one-on-one session, we can specially make a trading plan for you in these market conditions and the uncertainties that you might be able to face. But on top of that, we might be able to throw something extra, depending on the individual's conditions. It could be a bonus, it could be something else. So get in touch with us, and we will put you through with the account executive or me directly, so we can establish an account for you. For whatever other questions you might have, just throw us an email at webinars@gdmfx.com, or if there are any more questions you cannot find answers to on our website, gdmfx.com, you can always ask the support department on the pop-up chat for direct link to us. That's all about for today's session, ladies and gentlemen. Now let me remind you one more time, we're getting very close to our final goals of this month. We're going to talk about the dual grid trading system the next time. This is going to be this Friday, not tomorrow but the day after. And of course, the next week we will have our final session before we get to Good Friday, which is 29th. This will be the advanced range trading system, but that is going to be next Wednesday. Don't miss the opportunity to put the whole picture together. That's all for today. Thank you for being with us. I'll see you next time. Thank you. Bye-bye.